Hello, I'm Debbie Bell Hosking for Finextra TV here at EBAday 2023 in Madrid. And I'm joined by Peter Dehaan of SmartStream. Peter, welcome.
Good morning, Debbie. Thank you for having me.
So good to have you here in Madrid. And we're talking liquidity, are we not?
We are.
So my question to you is, what would you say are the biggest current challenges banks are facing with liquidity? And are there any lessons to be learned from the recent collapse of some US banks?
Okay, so the way that I see it is it's all about accurate real-time data. So banks would naturally rely on and be underpinned by the ratios and the metrics that they have to support for loan-to-deposit ratio, LCR, liquid asset buffer. If you overlay that against the three banks that collapsed, now three banks collapsed in 2023, there was a barren period of failures in 21 and 22. But if you look at the last decade, 50 banks, according to the FDIC, have failed in the last 10 years, which is a phenomenal amount. When you look at through an asset and liability lens on the assets vis-a-vis the liabilities, you're talking over 6 trillion in assets and over 5 trillion in deposits, which is a phenomenal amount, which has kind of been taken out of the market.
So those are the challenges. So now let's think about vulnerabilities. Peter, in your opinion, do you think that the global banking system is looking more vulnerable, particularly as interest rate rises are pushing pressure down on capital and liquidity? Do you see a liquidity crisis looming on the horizon?
So it's all about discipline. So when rates were zero essentially across the globe, discipline still had to be there across treasuries and cash managers. As rates have gone up to 5% and on the increase, there's more focus on not only discipline, but then there's opportune costs and opportune losses where banks can be very, very long or very, very short. Again, if you offset that against the asymmetric entry from QE to QT, so now there's a lot more money in the coffers of banks, which is having to be dealt with. Another way to kind of look at it is a lot of treasurers are focused more on liquidity than they are on capital. Now, the way that I see it, and a treasurer once told me that banks can perish two ways. You can perish through capital, which is like going via a terminal illness, or you can go very, very quickly in the form of a heart attack through liquidity mismanagement. So that's where we have it. So do I see more banks collapsing? Very much so.
And on that point, why or how do you think banks got into this situation? What happened to precaution management, or do insured deposits play a role?
So I think it goes back to, so when rates were zero again, people had different focus. It wasn't about net interest margin because there was no real money to be made. And then there was a lack of investment. So banks, and the further you get into banks, you'll find out that within the infrastructure that kind of manages their cash management and intraday business is antiquated and fractured. So a lot of people are managing intraday balances on Excel. I once met a senior treasury person and I said, what is your current state vis-a-vis your future state looking like? He said, my current state is Excel, my future state is not Excel. I've got nothing against Excel, but you shouldn't be managing multi-billion-dollar book on Excel. So if you then look at how the market's changed and on the insurance side of it, if you look at you have to go back to 2008 to see Washington Mutual lost 16 yards across a 9-day period. So the run on the bank was 9 days. You look at Silicon Valley Bank that lost 42 yards in a 24-hour period, which is essentially driven by uninformed people telling uninformed people what they should do with their money, which doesn't kind of lead to anything good. On the insurance side, when you're looking at the US and for insurance being 250,000 under the FDIC versus in the UK for FSCS, which is 85,000, there's obviously a disparity between the 250 and the 85. The normal person on the street wouldn't even know how much they're insured for, to be honest. So I don't think, does that really play a role in it? Probably not. How many people have got over 85,000 or over 250,000 either side? So again, I think the uninformed to uninformed is a powerful message.
Uninformed to informed, but also you were
Uninformed to uninformed.
uninformed to uninformed. And of course, you're also talking about technology there as well. So my next question to you is, how do we bridge those key technological gaps towards implementing a real-time intraday liquidity system?
So it goes back to infrastructure again and the lack of investment. So depending on the size of the institution, so tier ones, well, the way that I kind of look at it is like the three Bs. You can either bolster your existing setup, and if it's Excel, you can't really bolster that anymore. You can either build something or you can buy something. So you're left with three options. If you're a big tier one, you're probably going to go down the build route, because a lot of the banks, and having worked for large institutions, they're essentially tech companies with banking licenses, so they're able to do it. But once you come down into the lower tier 2, tier 3, tier 4 and challenger banks, they need to partner, and technology companies need to complement what they've got already to ensure that they're better placed, because treasurers and cash managers are going to be put under more pressure by their boards and by the regulators to make sure in what if scenarios they have everything in place to cater for that. So it all boils down to complementing and partnering with technology that's available.
Well, Peter, thank you. It's been great to have this discussion on liquidity, because it is very much a topic at the moment. So thank you for joining us.
Yeah, thanks very much, Debbie. Have a nice day.